Well, in overnight trading, the Nasdaq once again demonstrated that it is the high beta market of the US share market. And by that, I mean it's the one that makes the biggest moves in either direction when the market is moving. When the markets fall, the Nasdaq falls the furthest. And when the markets in the US rise, it's the best performer. And that's exactly what we saw again last night. The Nasdaq was up 1%, the S&P 500 up 0.5%. The Dow Jones Industrial Average actually dipped slightly. So it goes to show that when the markets are moving, the volatile component will generally always be those high-flying tech stocks, and that's exactly what we saw in US trading last night. Now, a lot of the rally that we saw had to do with the macro as well as the solid reporting season that we've just seen. The tech stock support came because US rate cut hopes are rising. Now, earlier in the week, we saw them down at 88% probability of a rate cut after the US Federal Reserve meeting on the 17th of September. That increased in overnight trading to 95%. And it seems very much due to the recent data. The previous session, we'd seen ISM data that showed manufacturing especially was much weaker than expected. And then some jobless claims data last night added to that narrative. Now, these are very important reads coming as they do ahead of Friday night's read on the non-farm payrolls. And if non-farm payrolls come in line with expectations for just 75,000 new jobs last month, we could once again see market investors piling into the share market on a firming expectation of rate cuts to come later this year. So also, of course, the potential for lower interest rates caused a rally in bonds. Bond yields fell in Europe and the US. Of course, the gold price found good support, hitting another all-time record high and getting close to $3,600 an ounce in the spot market. It was higher than that in futures trading. So the gold price once again hitting record highs. Gold stocks have been a feature of trading here in Australia over the course of this week. It looks like those investors who are buying the stocks up and really making those share prices rip higher could face more rewards in trading today. Having said that, yesterday the Australian share market was the outlier. Despite modest falls across the region, the Australian share market was hit hard. The ASX 200 fell by 1.8%, the biggest fall we've seen in 4 months. And a lot of that had to do with the surprise result that we got on the national accounts. Now, as we know, GDP is a measure of how much the economy is growing, and the national accounts data released yesterday showed the Australian economy expanded in the second quarter by a rate of about 1.8%. Now, that not only is a big bounce back from the first quarter's 1.3%, but it's higher than most economists were predicting. Those consensus estimates were around 1.6%. So the turn in the outlook for growth, that is the return from weakening to strengthening, and the fact that the number came in higher than forecast was a very good reason for investors to think over the longer term the Australian economy is healthier than we'd realised. But in the short term, it had a big impact on share market trading because those numbers make a rate cut less likely. And what we're seeing in Australia is an illustration of a principle that we've been putting in front of our customers for the first half of this year. That is that central banks are no longer acting in concert. They're not coordinating their activities around the globe. Instead, they're responding to the data of their individual countries. And with Australian growth recovering well, inflation bumping up, and unemployment looking very much contained and closer to full employment, the case for a rate cut is diminishing in Australia, despite the fact that it's strengthening in the US. And we expect to see more divergence. We know, for example, the Bank of Japan maintains a tightening stance, whereas many other banks, such as the Bank of England and Sweden, are maintaining easing biases. So that difference means that individual data becomes more and more important, and in particular, inflation, employment, and growth data become key to determining what central banks might do in the near and far future. So we're looking for the long-term impacts of that to win out. That increased growth and better expected growth does eventually fall through to the bottom line of corporates. The sorts of groups that might be beneficiaries of that sort of move are those that are exposed to the broader economy. And so given that surprise GDP result, we could, for example, see support for banks and broadly based businesses such as supermarkets on the back of that better activity than expected. But of course, a lot of the action was focused on the US. And last night, Alphabet shares were up more than 9% in trading after an antitrust ruling. Now, there were concerns that the court case put forward would see that Alphabet would have to sell its Chrome browser, move away from the Android system, and give up its preferred status as the search engine on Apple devices. So all three of those rulings went in the company's favour, and it's no surprise that Alphabet received great support in share market trading after those clouds were cleared away by the court. However, the news wasn't all good. Salesforce announced last night that it'll be cutting 4,000 jobs, and we use AI to replace those workers. However, at the same time, it also unveiled a 10% revenue gain over the second quarter, which was below estimates, and also guided estimates for the third quarter lower. And that combination of factors really weighed on the share price. Salesforce shares down 24%. This year, and it's pretty clear that the business model for Salesforce is being questioned by analysts and investors. Debutante Figma, which only started trading a few weeks ago, has fallen steadily since that August IPO. It rocketed higher, trading above $124 a share. However, after announcing yesterday or last night that second quarter revenue was up 41%, but below expectations, it fell hard in aftermarket trading. Figma shares down 14%, are now less than half what they were at the peak price, and some concerns too about future earnings given that downward revision of revenue estimates. So overall, individual stocks can still perform very well on good announcements, but poor announcements continue to be punished by investors in the share market.